Earnings season kicks off again with big banks, and soon enough we're going to be into the holidays. But wait a minute, hold on. A few out there are calling for a repeat of last year's December stock market meltdown. According to Real Vision's Raoul Pal, a repeat of that meltdown may be unavoidable because we're coming into a period of illiquidity for equities. He also stated that the blackout period for companies comes around earnings, when the share buybacks will start to slow. Powell also noted the risks from the short-term borrowing market or the repo market and the possibility of baby boomers selling as a rule of their individual retirement accounts. Essentially, the baby boomers need to start selling when they reach 70 and a half years old for their retirement accounts. Along with Raoul Pal is Jim Cramer, the Mad Money host, who is also warning of a possible sharp market decline. In today's video, we're going to leave Raoul Pal for another day, but focus on a recent video from Jim Cramer. So, let's take a look. The video from Jim Cramer was brought to my attention by LKZ. I'll provide a link to Cramer's video so that you can watch that and compare it with my responses. Essentially, LKZ is wondering about a bearish MACD formation. Again, I hope the link in the description under where it says show more works. If it doesn't, maybe LKZ can post it with comments to this video. But anyway, here is my play-by-play of Cramer's video. Cramer starts the video talking about emotions and that you want to be logical in your decisions. He then mentions the monthly chart of the NASDAQ at about 55 seconds into the video and discusses the warnings about hitting the top of a consolidation period. The problem Cramer focuses on is the consolidation period is ending right now. And the warning from his technician is that he expects a breakdown not only for the NASDAQ, but for the entire market and the S&P 500. Cramer then goes to the weekly chart at about 2 minutes and 14 seconds into the video. Using the weekly chart, Cramer talks about the recent lower high in the S&P 500 and the oscillators showing a loss in momentum and lower volatility. Expecting a sharp decline, Cramer then moves to the daily chart at about 3 minutes and 50 seconds into the video and talks about the current sideways channel and the recent double top in the S&P 500. He then shows the possible breakdown in the S&P 500 to about 2600 using a trend line from late 2018. So this would be about a 10% decline. And then Cramer talks about the bearish crossover of the MACD at about 6 minutes and 10 seconds into the video. Since I got to the point that LKZ mentioned, I did not finish watching the video. So let's now go to our charts and see how I view the same circumstances. So first, a fundamental difference between me and traditional technicians. It's that I believe the oscillators are the heart and soul of the market, and they are primary in their indication of where the market may be going. In that sense, I believe the price chart is useful but of secondary importance. So back to Cramer's video. One small issue is that he goes from the NASDAQ chart to the S&P chart. Now, this is a pretty minor problem, but those charts do tell slightly different stories. So for my analysis, I'm going to stick with the S&P. Now, Cramer is correct in starting with the monthly chart and ending up with the daily chart. But for my analysis, I'm just going to start with the daily chart and only go to the weekly chart because the monthly chart really doesn't bring anything new to the discussion that we'll see there from the weekly chart. So beginning with the daily chart here, this is a 1-year daily chart. A basic problem with Cramer's video is that the MACD crossover happened in September. So let's take a look at that. Moving on down here, we see that the crossover actually happened here, say in mid-September. So that was a while ago. And essentially, that's old information. So in his video, He should have been looking for the MACD to bottom and head up in a bullish pattern, as you can kind of see here. Here's making the attempt in early October, bottoming here, and trying to base at that point. But he's not going to discuss that. And why? Well, if he pointed that out, it would invalidate his whole thesis. But you and I, we're looking for this bottom. We're not back here a couple of weeks at the crossover. We're already down here looking for a bottom, looking for that trend line to head back up. To me, that is a real fatal flaw in the argument. Another issue comes when Cramer talks about the double top. Let's go back up here to the price chart, the double top. There it is, right here. And that's true. It is a double top. But the analysis ignores the much more important lower trend line that leads upward, say all the way back here, continues. And this again is a price chart. This lower trend line all the way from back here. To me, that is much more convincing of the direction of the market than that double top. Now, even more important, the analysis totally ignores the lower trend line of several of the oscillators. So let's take a look at those. I've already drawn those in. Lower trend line of the MAC, heading on up. Histogram, heading on up. Price rate of change, heading on up. Relative strength, on up. Stochastics, on up. So basically, the analysis totally ignores all of those oscillators. Now, for me, it's more important because I do focus on those oscillators. But traditional technicians, they don't. Therefore, they miss it all of the time. And so to me, that underlying trend line on the price chart and on all or majority of the oscillators is much more convincing than that double top. So now let's go to the weekly. Okay, now we're looking at the 2-year weekly chart on the spiders, and I only want to show you a couple of things here, so this is going to be relatively quick. Now, back to a couple of videos that I've talked about this time frame here where we did have that plunge down. Again, in my humble opinion, this was kind of a self-fulfilling prophecy where we were at a level here and all the technicians got nervous and then we sold off. So I kind of ignore that, and that's why I have this trend line here at this level. So at this point here, this is the double top that supposedly we're experiencing right there, that double top. But here is the underlying trend line. The underlying trend line goes back 2 years or even longer. To me, that's much, much more convincing. Now, you would have an argument if we really came through here and did violate this level here. So I'd wait for that before you start arguing about a steep sell-off. Now, another thing that I want to point out here in the MAC, they talk about, Cramer talks about the crossover that happened, say, in mid-September or so. Again, this is the weekly chart, so it shows up a little bit different than the daily chart. But let's go back to late 2018 when we had that big sell-off. Here's the crossover. The fast line crossed through the slow line. We're at an upper level. We're at about a 5 level here. The crossover happened here. That was bearish. You see how fast and steep that decline in the fast line was, and it created all of this separation between the fast line and the slow line all the way down here before it bottomed. When you get something like that that's fast and steep, that's when you get the sell-off. Here we had a crossover. It got turned by the Fed talk about easy money. We had another crossover at that point, and it got turned. Now, we didn't quite make it up above for another crossover, but it doesn't really matter. You just take a look at this whole formation here is very shallow compared to this. So in order for this to turn into a steep sell-off, you have to have the fast line move through the slow line real fast, sharp, and hard. You don't have it here. It's possible that we could all of a sudden turn, but right now, I don't see anything. There is no inkling of a steep sell-off, at least by the weekly chart. All right, let's go to another chart. This last chart here is the VIX, and I'm using stockcharts.com. for this representation here. So when I'm developing a thesis, I don't just look at the monthly, the weekly, and the daily charts of an index. I mean, that's the great place to start for sure. But I always look at other relevant indications. Never just one, never just two. Always other relevant indications. And one of those relevant indications is the VIX, or the fear factor. And if you remember, I stated earlier that as part of Cramer's argument, he says the market will decline because of lower volatility. And then he shows an oscillator indicating lower volatility. For me, I look directly at the VIX for volatility. The VIX is one of the best measures of volatility, if not the best. And if Cramer would have done an analysis on the VIX, he would see that lower volatility leads to a higher market, not a market decline. So the complete opposite of his argument. So looking here at the VIX, you can see, I can't draw any lines, but hopefully I can use my cursor so that you can see here, is that looking here at the MAC, we topped in the MAC here, and at the point here, we're lower than we were just say in mid-August. So things are calming down, lower volatility. If you want to go back to late 2018 to find higher volatility, hence a sell-off, you got to have that move in the MAC and you got to have it spiking up here. That's going to cause or perhaps be consistent with a sell-off. Not this. We're declining. Volatility is calming down, which means the market's going up. It's the opposite argument. And to me, that one statement where he says that the lower volatility comes along with that steep decline, that one statement invalidates his entire thesis, in my humble opinion. Now, lastly, Cramer says that he's troubled or worried about the potential decline. Now, if there is anything I want you to understand is that my thesis is based on being a contrarian. At some point, I want all of you to be in a position with several strong stock holdings. And once you've accomplished that, then you want the market to decline because that's when stocks go on sale. It's much easier to buy low and sell high when stocks go on sale in a decline. So I'm all for a decline. Bring it on. And for today, that's ChewDog Charts. Thank you.